In October 1907, the United States had no central bank, so when Wall Street began running out of cash, the man deciding which institutions might live was a 70-year-old private banker working from his library. On October 16th, speculators failed to corner United Copper shares. The losses exposed their connections to New York banks. Depositors demanded cash. The New York clearinghouse protected its member banks, but the fastest-growing institutions were trust companies, and most trusts were outside that club. They held roughly $5 in cash for every $100 deposited. National banks held about 25. Trusts supplied short-term money that let brokers buy securities before pledging them for overnight bank loans. During a run, the chain reversed. Depositors demanded cash, trusts withdrew credit, brokers sold assets, and falling prices created more fear. When Knickerbocker Trust asked for help, J.P. Morgan sent Benjamin Strong and a team to inspect its books. They could not establish that it was solvent. Morgan refused the rescue. On October 22nd, after nearly $8 million had been withdrawn, Knickerbocker closed. That decision did not contain the fear. It multiplied it. Lines formed at other trusts. To raise cash, trusts stopped financing stockbrokers and called loans back. The machinery under the market began to seize. Morgan's library became an emergency command room. Accountants examined balance sheets. Bankers were summoned, assigned contributions, and pressed to support institutions judged capable of surviving. At the stock exchange, overnight loan rates reached 100%, and sometimes no money was offered at any price. Morgan solicited cash from major institutions and sent it directly to the exchange's loan post. New York banks released roughly $25 million, keeping the market open. But Morgan was not manufacturing money. The Treasury transferred more than $37 million into New York national banks during 10 critical days. The clearinghouse issued loan certificates, allowing member banks to settle with paper promises instead of scarce cash. Banks limited withdrawals. Gold arrived from overseas. The clearinghouse could create liquidity for members, not automatically for trusts feeding the market. Morgan forced rivals into one room. That was his power, and the system's weakness. Survival depended on who entered, what the books showed, and whether a private financier agreed. This was not one heroic check. It was an improvised central bank, assembled from private authority, public money, shared information, and selective access. It worked, but only after an institution outside the club had already fallen. Here is what happened next. Emergency cash, certificates, restricted withdrawals, and incoming gold helped the panic subside. But credit and production fell across the wider economy. In 1908, Congress created the National Monetary Commission. J.P. Morgan died on March 31, 1913. 9 months later, President Woodrow Wilson signed the Federal Reserve Act. That is how the crisis truly ended. America built a permanent central bank for emergency liquidity, so the financial system would never again wait for one private man to open his library.